Welcome everyone to the Deep Dive. So glad you could join us. Pull up a chair, maybe grab a coffee, get comfortable. Because today, we're really getting into something that, well, it touches every single one of us, our relationship with money. More specifically, we're doing our deep dive into the ultimate guide to the psychology of money. How to beat the 9 biases costing you thousands. Now look, if you're like a lot of people, you probably hear finance and immediately think, okay, numbers, spreadsheets, maybe complex data, cold, hard facts. But here's the thing, and it's something we often overlook, but it's so crucial, and we're going to unpack it today. Your behavior with money. That's actually far more critical to your financial success than just knowing the theories of the economics. Our brains, they're brilliant machines, right? But they can play some, let's call them tricks on us. Experts call them cognitive biases. And these little mental quirks can quietly, but very effectively, drain our bank accounts, our portfolios. They can cost us not just potential gains we might have had, but actual hard-earned thousands of dollars.
So this deep dive, we've designed it to be your shortcut, your guide to understanding these subtle mental patterns. The goal is to equip you, really, to make smarter, more informed, and ultimately more profitable financial decisions.
It's truly fascinating, isn't it? And I think it's often underappreciated. Knowing what you should do with your money may be the textbook answer. Well, that tells you absolutely nothing about what actually goes on in your head when you try to do it. We're talking about these deep-seated patterns. Sometimes they're even unconscious. They significantly influence our financial choices, often without us even realizing just how much sway they have. Understanding these inherent human patterns, it's not just, an academic thing. It's absolutely key. Key to making financial decisions that are more grounded in reality, less swayed by fleeting emotions. And ultimately, decisions that are aligned with your long-term goals. It's about recognizing that there's a human being with all our complexities at the heart of every single financial transaction.
Okay, let's unpack that a bit more, because it sounds like we're talking about something really fundamental, just being human, basically. We hear these terms thrown around, right? Cognitive bias, psychological bias, especially when people talk about decision-making. But what do they actually mean when it comes to our money? And why are they so powerful?
Well, at its core, a cognitive or psychological bias is just a systematic pattern of thinking, or maybe a deviation from what we'd call purely rational judgment. It can cause us to interpret information or even the world around us in a way that's, not entirely rational. It's essentially what happens when we're just being human. Our brains take shortcuts, or we react instinctively based on feelings.
Right, mental shortcuts. And you've probably experienced some of these yourself, even general ones, maybe without putting a label on it. Think about the spotlight effect. That feeling that everyone's watching you, scrutinizing every little thing you do. When in reality, most people are probably wrapped up in their own stuff and barely noticing.
Exactly.
It's that same kind of principle, our brain playing a little trick, but applied to money. These mental quirks can cloud our judgment. They can stop us from investing wisely or managing our money effectively. And let me tell you, from what I've seen, they can be incredibly hard to shake without conscious effort.
You're absolutely right. These aren't just abstract ideas for, academics in ivory towers. They are deeply ingrained realities of how we think. Most people have bumped up against them, whether they called it a bias or not. And the central theme, the thing that really comes through powerfully from the research is this. How you behave with money is vastly, profoundly more important than what you simply know about finance theory or how markets work. This soft skill, understanding our own psychology, it's hugely underappreciated.
It's striking, isn't it? Finance is almost always taught like it's just math.
Right. You get formulas for valuation, historical data, correlations, optimal portfolio theories, all very precise. But these quantitative tools, while they have their place, they tell us zero about the internal struggle, the emotional roller coaster, or the mental blind spots we face when we actually try to implement those strategies in the real messy world. That disconnect, that's where biases thrive.
So to really get a handle on this human side of money and just how deep these patterns run, maybe we should look back a bit at history. Because this idea of investor irrationality, it's not new, is it? It seems like it's as old as markets themselves. And there's probably no better historical example, the one everyone points to, than the Dutch tulip mania back in the 16th century. Can you paint a picture of that for us?
Oh, it's a classic for a very good reason. Picture this. Holland, 16th century, tulips, these beautiful exotic flowers. They've just been introduced from Constantinople. A guy named Conrad Gessner brought them over. And they became an instant status symbol for the Dutch elite. They were vibrant, unique, really difficult to cultivate, which made them incredibly rare.
So desirable because they were rare and beautiful. Makes sense so far.
Exactly. But what started as genuine appreciation quickly spiraled. It turned into intense speculation. People weren't just buying tulips to plant in their gardens anymore. They were buying them purely to sell them on, hopefully for a profit. Prices started climbing. And climbing astronomically. Soon, these tulip bulbs, many still just in the ground, mind you, were being traded on local market exchanges like they were stocks or bonds, sometimes changing hands multiple times in a single day.
Wow. For flower bulbs.
For flower bulbs. And the obsession, it trickled down from the wealthy merchants right down to the middle class. People were mortgaging their homes, investing their entire life savings, literally trading whole estates for a single, particularly rare tulip bulb. It became this speculative frenzy, a total bubble built on irrational excitement, a collective delusion, really. And like all bubbles, eventually, inevitably, it popped.
And the crash must have been brutal.
Devastating. It wiped out fortunes overnight, plunged so many people into ruin, all over tulips. It's a stark lesson in herd behavior and speculation.
That is such a striking story of irrationality. It really makes you wonder, did the early thinkers about economics, did they see this kind of emotional stuff playing out?
They absolutely did, even if they didn't use our modern terms like bias. Even back then, figures like Adam Smith, often called the father of modern economics, he recognized that human emotion played a significant role in economic decisions, albeit within his framework of self-interest. Then there was Jeremy Bentham, another really influential economist and philosopher. He pushed it further. He argued that basically every human action is about maximizing utility, seeking happiness and pleasure, avoiding pain. This fundamentally challenged that old model of Homo economicus, the idea that people are purely rational, self-interested calculators, just maximizing profit logically. The idea that feelings were central to economic choices. That was pretty revolutionary back then.
And then fast forward a bit to more modern psychology.
Right. Fast forward to the 1980s. Cognitive psychologists Amos Tversky and Daniel Kahneman, names you probably recognize. Kahneman won a Nobel for this work. They published seminal research, Judgment Under Uncertainty, Heuristics and Biases. Their work showed empirically, through careful experiments, that our intuitive judgments often don't follow the basic laws of probability. They identified specific heuristics, which are basically those mental shortcuts our brains use to make quick decisions. And they showed the systematic biases these shortcuts create. Things like representativeness, judging based on stereotypes, availability, judging by how easily something comes to mind, anchoring, relying too heavily on the first piece of information. Their work just profoundly highlighted how much our thinking can deviate from pure logic. It really laid the groundwork for modern behavioral finance.
Okay, so we've got this deep history, this psychological foundation. Why is identifying these biases so incredibly important today? Why does it matter so much for us, in our everyday financial lives? What's the real practical benefit?
The practical benefit is, frankly, immense. By simply understanding how these biases affect our investment process, individuals and their advisors, if they have them, can significantly improve their economic outcomes. They can actually achieve their financial objectives more reliably. From my own experience, working as a financial advisor for over 2 decades, I've seen multiple market meltdowns. Think Black Monday in '87, the Asian crisis in '98, the dot-com bust in 2001, and of course the big one, the global financial crisis in 2008-2009.
Right, those were tough times for investors.
Incredibly tough. And during those periods, identifying a specific behavioral bias in a client at just the right moment, it literally saved them from potential financial disaster. I can't tell you how many hours I spent talking clients down from the ledge, so to speak. During those steep market drops, the emotional pain of seeing their portfolio values plummet can be just overwhelming. It leads people to want to panic sell risky assets at the absolute worst time, locking in huge losses and completely derailing their long-term plans. My role in those moments often shifted from financial analyst to, almost a behavioral coach, helping them recognize the bias driving their fear, maybe loss aversion, maybe recency bias, helping them avoid making irreversible, emotionally charged mistakes.
So it's about managing the emotion as much as managing the money.
Absolutely. That behavior modifying advice, just holding their hand through the fear, it built tremendous trust, sure. But more importantly, it helped clients stay the course towards their most critical financial goals, like retirement or funding education.
That's a powerful demonstration of the real-world impact. But what if someone knows they have a bias? Is it always about trying to eliminate it? Or do you sometimes have to, work with it?
That's a really insightful question. And no, it's not always about outright elimination. That can be really hard, especially with emotional biases. In some cases, instead of fighting a really deep-seated bias or impulse, we've learned it's more effective to adapt to it in a structured way. For example, some people genuinely have what you might call a gambling instinct. They enjoy the thrill of speculative bets. They want to take risks with some of their money, even if rationally it's not the best strategy for their whole portfolio.
Right, they like the excitement.
Exactly. So instead of constantly fighting that core urge, which can be counterproductive, maybe leading them to make rash decisions with all their money in secret, the advice might be, okay, let's carve out a small, clearly defined percentage of your overall portfolio, say 5%, maybe 10% max, and that's designated specifically for those risky speculative bets. This lets them scratch that itch, engage in that behavior they enjoy, but it keeps the vast majority of their wealth, the serious money for their future, in a prudent, diversified, long-term allocation. It's about channeling the bias, managing it, rather than pretending you can just suppress it entirely.
So managing, not necessarily eliminating.
Right. The overall goal, whether it's through direct intervention like talking someone down or adaptation like the gambling allowance, is to foster a heightened awareness. Awareness of these biases, their implications, and finding practical ways to either moderate their impact or adapt to them. It's all about leading to better financial decisions and outcomes. It's not about achieving some kind of robotic financial perfection. It's about being psychologically reasonable, which is a much more attainable and frankly sustainable goal for humans.
That sets the stage perfectly for digging into the specifics, our main event, the 9 biases costing you thousands. But before we jump into the first one, maybe we should quickly clarify a distinction you mentioned earlier, because it affects how we might deal with them. In behavioral finance, biases are often grouped into 2 main types, cognitive and emotional. What's the difference?
That's a crucial distinction, yeah, and it really guides how we approach trying to mitigate them. So cognitive biases are generally rooted in faulty information processing or maybe memory errors. Think of them as systematic glitches in our thinking or reasoning, how our brain handles data. Emotional biases, on the other hand, they stem more from spontaneous feelings, gut reactions, emotions like fear, greed, hope, regret. They're often much harder to control or just reason away with logic.
Okay, so cognitive is about faulty thinking, emotional is about strong feelings.
Exactly. And while some biases can definitely have elements of both, like a cognitive mistake might trigger an emotional reaction or vice versa, this framework helps us figure out how and when to adjust. Generally speaking, cognitive biases are often considered easier to correct. We can use systematic approaches like checklists, algorithms, or just consciously applying different thinking frameworks. We can train ourselves to process information differently. Emotional biases, because they're tied so deeply to our feelings or primal responses, they're much more challenging to simply think our way out of. They often require stronger strategies, like pre-commitment devices, setting rules in advance, or sometimes even bringing in a trusted third party, like an advisor, to help manage the emotional response.
Got it. That's a really helpful framework. All right, let's dive into the first one. This is a classic cognitive bias, one that keeps us stuck in our own perspective. Bias 1. Confirmation bias. You mentioned it falls under belief perseverance.
Yeah, that's right. Belief perseverance. Confirmation bias describes our innate tendency as humans to selectively seek out, interpret, and remember information that confirms what we already believe or hypothesize. At the same time, we tend to actively ignore, dismiss, or downplay any evidence that contradicts our existing views or what we want to be true. It's like wearing blinders, really. Only seeing what aligns with your pre-existing narrative, filtering the world through a very specific preset lens.
So if I think a certain stock is a winner, my brain will actually help me find news articles and posts that say it's a winner and kind of gloss over the negative stuff.
Precisely. You'll notice the bullish analyst reports, the positive forum comments, and that negative article, oh, that analyst doesn't know what they're talking about, or the source is biased. Your brain conveniently rationalizes it away.
Wow. So it's not just a passive preference. We actually actively seek out the confirming stuff and actively downplay the challenging stuff. That's powerful. How does this show up in actual investment mistakes, the ones that cost people real money?
Oh, it manifests in so many costly ways. Investors who are highly susceptible might, as you said, only seek out positive info about an investment they already like. They read only the bullish stuff, stay in their echo chamber, and remain completely unaware of potential risks or declines. We call it creating information silos. They might also blind themselves to data that contradicts their favorite investment screens or rules. For instance, maybe they only trust stocks breaking a 52-week high as a buy signal. They'll focus on the times it worked and ignore all the times it didn't, or the underlying reasons why it might not be reliable. We see it a lot with company stock, too. Employees might over-concentrate their holdings, putting maybe 50% or even more of their net worth into their employer's stock.
Because they feel they know the company best.
Exactly. They hear the internal buzz, they feel a personal connection, they think they have insider knowledge, even if it's just water cooler talk. They completely ignore the fundamental wisdom of diversification, failing to see the massive, concentrated risk they're taking. And ultimately, confirmation bias leads people to hold on to incredibly under-diversified portfolios. They get infatuated with certain stocks or sectors, their darlings, and they just refuse to hear anything negative. It becomes an emotional attachment to being right.
So that classic Wall Street saying, don't confuse brains with a bull market, that really hits home here, doesn't it?
Absolutely.
If you're prone to confirmation bias, when the market's going up, you attribute all your gains to your own genius, your amazing stock-picking skills. You're less likely to learn from what the market is actually doing, or admit maybe you just got lucky because everything was rising.
You feel like a genius, yeah. And that sets you up for a much harder fall when the tide inevitably turns. You haven't learned, and you're overconfident. To beat this, you have to make a conscious, active effort. Intentionally seek out dissenting opinions. Find information that challenges your initial beliefs. Make it a habit. Read reports from analysts who are bearish on your favorite stock. Talk about your ideas with someone who holds the opposite view. Listen to their reasoning.
That sounds uncomfortable.
It is uncomfortable, but it's crucial. Embrace diversification not just as a portfolio strategy, but as a mental tool. It forces you away from a narrow, confirmed view. It's really about being open to the possibility that you might be wrong, even actively seeking out arguments, proving you might be wrong. That's how you genuinely refine your understanding and avoid costly confirmation traps.
Okay, being open to being wrong. That's tough, but essential advice. Let's move on to something I think a lot of us wrestle with, especially when we look back at past decisions. Bias 2. Regret aversion and its close cousin loss aversion. These sound deeply emotional.
Oh, they definitely are. And trust me, we all wrestle with regret. The core idea here, which behavioral economics has shown very clearly, is that the psychological pain of a loss feels significantly worse, maybe twice as bad, as the pleasure of an equivalent gain. Losing $100 just stings much more than finding $100 feels good. So regret aversion is this drive to avoid making decisions now that we might regret later. It can make us indecisive, or conversely, it can make us hold on to losing positions for too long because selling means admitting a mistake, crystallizing the loss, and facing that regret. We hope it'll come back. Or we might hold on to winners too long because we fear the regret of selling before the peak, missing out on those last few dollars of gain.
Yeah.
It cuts both ways.
That really, it feels like it's wired into how we process pain and disappointment. How does this play out in the investment world? What are the concrete mistakes it leads to?
It leads to some incredibly common and costly behaviors. For instance, during market downturns, when things feel risky and uncertain, investors might sell assets too quickly. They just want the pain to stop. They tell themselves, I'll get back in later when things calm down. But because they're so sensitive to the immediate pain of seeing losses mount, they sell low. And timing the reentry, almost impossible. They often miss the rebound and lock in those losses permanently.
So trying to avoid the pain actually causes more financial pain.
Often, yes. It can also make people overly conservative after they've experienced a loss, maybe in a previous bear market. They become gun-shy. They avoid taking the necessary risks, even appropriate risks for their goals, which can lead to long-term underperformance. They might miss their retirement targets because they were too scared to invest properly after getting burned once. They might also unduly shy away from markets or sectors that have recently declined. They see bargains, logically, but the memory of recent losses is too painful, too fresh, so they miss the buying opportunity. Fear of regret holds them back.
And you mentioned holding losers too long and selling winners too soon.
Yes, that's the famous disposition effect, a classic result of loss and regret aversion. Holding on to losers. That's being risk-seeking when you're down, desperately hoping to just get back to, even to avoid the regret of locking in the loss. Selling winners too quickly. That's being risk-averse when you're up, wanting to lock in the gain now because you fear the regret of watching it evaporate. It feels safer to take the smaller win. People might also prefer stocks of safe or good companies, maybe big familiar names, even if less familiar alternatives offer potentially higher returns. Why? Because if the familiar company does poorly, well, who could have known? But if the bolder choice fails, the personal regret feels much sharper.
That makes sense. Less personal blame with the safe choice?
Exactly. And on the flip side, holding winners too long isn't just about greed, it's often about the fear of missing out, FOMO, which is another form of regret aversion, fear of regretting selling too soon. They ignore the fundamental need for rebalancing or the simple fact that trees don't grow to the sky. This leads to dangerously concentrated, imbalanced portfolios.
Do you have a real-life example that sort of captures this?
Well, think about a well-known retailer like TJX, the parent company of stores like Winners or Marshalls. Back in early 2020, just as the pandemic was hitting, the stock was trading around, say, $65. Then lockdowns happened, huge uncertainty, worries about the economy shutting down. The stock got cut almost in half, down to around $32. Understandably, there was a massive wave of fear of further losses, fear of regretting not selling. Many investors sold, acting on that intense pain and regret aversion.
Understandable reaction in scary times.
Very understandable. But here's the thing. Did the fundamental long-term value of that business really drop by 50% overnight? Arguably not. And look what happened since. The stock has performed remarkably well, hitting new highs significantly above its pre-pandemic levels. Many who sold near the bottom, driven by that fear of immediate loss and future regret, missed out entirely on that incredible rebound. They locked in the loss and missed the recovery. This isn't unique, it happens constantly. And it's not just average investors. Even Nobel laureate Harry Markowitz, the genius behind modern portfolio theory, a supremely rational mind, admitted he split his own personal portfolio 50-50 between bonds and stocks.
Not because it was mathematically optimal?
Nope. He did it, in his own words, to minimize future regret. He knew he'd feel the pain of missing out on big stock gains if he was too conservative, and he'd feel the pain of big stock losses if he was too aggressive. So he chose the middle ground to minimize the emotional fallout. It just shows how incredibly powerful this emotional pull is, even for the most brilliant financial minds.
Wow, even Markowitz. So if even he struggles, how do the rest of us conquer this deep-seated emotional bias?
It's about a fundamental mindset shift. You have to accept, truly internalize, that market volatility and temporary paper losses are not fines or penalties. They are the price you pay for admission to the potential for long-term market returns. They are the cost required to access the growth that markets have historically provided. It's like an entrance fee to a potentially amazing show. The trick is convincing yourself deep down that the fee is worth it, that the potential long-term reward outweighs the very real short-term discomfort. Focus relentlessly on your long-term financial plan. Why are you investing in the first place? Keep that goal front and center, and resist that primal urge to react to the daily noise, the scary headlines, the temporary dip in your account value. Understand that sticking with your strategy during the tough times when everyone else is panicking and selling is one of the strongest indicators of long-term investment success. Make a plan, commit to it, understand that ups and downs are part of the journey, not signals to jump ship.
Ride out the storm, knowing it's the price of admission. That's a really powerful reframe. Okay, building on that idea of reacting to what others are doing, let's talk about bias 3. Hurting. This is also emotional, right? And you said it's related to regret aversion.
Precisely. Herding is that classic human tendency to mimic the actions of a larger group, to follow the crowd, often without doing our own independent thinking.
Right.
It comes from a potent mix of things: wanting to get in on the action when it looks like others are making easy money, the psychological comfort and safety of being part of the herd, and absolutely that fear of being left out, FOMO, the fear of missing out, which is a direct form of regret aversion, fear of regretting not joining in. When everyone around you, your neighbors or friends, people on social media, seems to be getting rich from some hot new investment, it takes immense discipline and personal conviction to resist jumping on the bandwagon, even if your own logical analysis is screaming, danger.
And where does this lead? What are the classic investment mistakes driven by herding?
They're usually pre-spectacular and often end badly for the latecomers. Herding leads people to pile into get-rich-quick schemes or hot investment ideas, often with minimal research or understanding. They just follow the noise. This collective behavior directly fuels market froth and speculative bubbles in certain assets whose prices are driven way more by hype and momentum than by any underlying fundamental value. And these bubbles, as we saw with tulip mania, inevitably pop, leading to massive losses for the vast majority who got in near the top, swept up in the excitement. It's like that stampede analogy. Everyone's running frantically in one direction, but nobody really knows why they're running or where they're going.
So looking around today,
Or very recently.
Yeah.
Things like meme stocks surging based on Reddit hype, some cryptocurrencies seeing those insane rises and falls, NFTs, even past bubbles and things like marijuana stocks or maybe certain tech sectors without profits. Those all feel like prime examples of hurting creating bubbles.
Absolutely. Those are incredibly vivid, very recent, and for many very painful examples. And going back a bit further, the dot-com bubble of the late 1990s is another stark reminder. Seemingly endless money poured into internet companies that had no revenue, sometimes not even a product, just eyeballs or a concept. Why? Because everyone else was doing it. Prices were soaring. It was pure momentum chasing, collective excitement overriding logic. Classic herding. To beat it, you have to actively cultivate an independent mind. Constantly question the crowd. Ask why. Do your own research. Remember that famous saying, even a massive herd can stampede right off a cliff. Just because everyone's doing it doesn't make it smart or right for you. True, sustainable wealth, as we discussed with Ronald Reed, is often quiet. It's what you don't see. It's the steady, long-term accumulation, not the flashy, hyped-up trend everyone's chasing. And crucially, don't take your financial cues from people playing a completely different game than you are. Their goals, their time horizon, their tolerance for risk, they're probably vastly different from yours. What's right for them could be disastrous for you.
That's such a key point. Don't compare your game plan to someone else's highlight reel, especially if they're playing a totally different sport. Okay, let's shift gears back to a cognitive bias, one about how we process information and get stuck on initial impressions. Bias 4. Anchoring and adjustment. This one sounds like it's about getting locked onto a number or an idea.
Exactly. Anchoring describes our deep-seated tendency to rely way too heavily on the very first piece of information we receive. That's the anchor when we're making a decision. And then crucially, we make insufficient adjustments away from that anchor, even when we get new relevant information that should logically make us completely reevaluate. It's like dropping anchor in the harbor. Even if the tide changes or the wind shifts dramatically, if you don't consciously pull up that anchor and reset, you stay stuck in the initial spot, which might now be the wrong place entirely.
So we latch onto that first number or maybe the first fact we hear, and it skews everything that comes after, even if we try to adjust our thinking. How does this play out in real, costly investment mistakes?
It's surprisingly common and can be quite subtle or insidious. For example, investors often make forecasts for the overall market that are too narrow, too close to whatever the current level is. They get anchored to recent performance or the current mood, and they ignore the much wider range of historical fluctuations or future possibilities. Securities analysts, they're notorious for this too. They might issue an earnings estimate for a company. Then, even if the company releases significantly different news, maybe much better, maybe much worse, the analysts often only adjust their estimate slightly, sticking too close to their original anchor. They fail to fully incorporate the new reality. You can see it on charts where forecasts lag reality for ages. Investors also get anchored to past returns. If stocks did great for 3 years, they forecast similar returns going forward, anchored on that recent past, ignoring longer-term averages or changing conditions. They assume what just happened will keep happening. And they can get anchored to history in other ways, too. Fixating on the past economic dominance of certain countries like Japan Inc. in the 1980s, or the bellwether status of once mighty companies like maybe IBM decades ago. They fail to adapt their strategies as the world evolves and new leaders emerge because they're anchored to an outdated view.
Can you give us a more concrete example, maybe a hypothetical investor, to really illustrate how this works?
Sure. Let's take Alice again. Suppose she bought shares in ABC Company at $12. Stock does well, goes up to $20 after some good news. Great. But maybe she holds on, hoping for more. Then, some bad news hits. Faulty accounting practices are revealed. The company's outlook is now fundamentally much worse. The stock drops to $15. Now, Alice is anchored to that $20 high point. That's the number stuck in her head. Even though the company is now very different, the fundamentals have changed negatively, she might tell herself, I'll just wait to sell until it gets back to $20. That $20 is an irrelevant historical anchor now. But because she's anchored, she might hold on to a declining, fundamentally flawed asset way too long, hoping to avoid selling below that anchor point instead of cutting her losses based on the new reality.
And this affects professionals too. You mentioned real estate agents.
Yes. Classic studies showed that even experienced real estate agents were significantly influenced by the initial listing price of a property, an anchor, sometimes arbitrary, when they were asked to estimate its actual market value. It demonstrates how even irrelevant numbers can powerfully sway judgment, even for experts.
That's really eye-opening. So how do we avoid getting stuck on these anchors? How do we make sure we're making decisions based on current reality, not some past number?
It takes active, conscious, mental effort. You have to deliberately seek out diverse information sources. Don't just rely on the first number or opinion you encounter. Consciously challenge your initial impressions, your first facts. Ask yourself, is this number relevant now, or am I just stuck on it? When you're evaluating advice from an analyst, a news report, even a friend, specifically ask, is this person potentially anchored to a previous estimate, a past price, or some outdated view, or are they genuinely providing an objective, rational response based on the current fundamentals and new information? Be vigilant anytime you find yourself fixating on a specific price or figure that rationally shouldn't dictate your current decision. Try to force yourself to evaluate the situation based only on the current data, as if you had no prior anchor.
That's a great mental check to run.
Yeah.
Okay, let's move to another cognitive bias, this one about how we mentally categorize our money. Bias 5, mental accounting.
Mental accounting. This is a really fascinating one. It's our psychological tendency to treat money differently depending on where it came from, its source, or what we plan to use it for, its intended use. We effectively create these separate mental accounts or buckets for our money in our heads. Think like the salary bucket, the bonus bucket, the vacation fund bucket, the emergency bucket. This completely defies the basic economic principle that money is fungible. Fungible just means that any dollar is interchangeable with any other dollar. A dollar is a dollar is a dollar, right? But our brains don't naturally work that way.
So in our heads, a dollar earned from hard work feels different from a dollar won in a lottery, even though they can both buy the same cup of coffee.
Exactly. That's the core of it. And because we treat them differently, it leads to irrational financial decisions and investment mistakes. Think about windfall money, that unexpected bonus, a small lottery win, maybe a tax refund you weren't counting on. People often treat this as house money or fun money. They feel it's more expendable, so they're more willing to take big risks with it, maybe gamble it or spend it frivolously rather than using it strategically, like paying down high-interest debt or adding it to their long-term investment.
Already effect.
Precisely. Experimental studies confirm this. Traders given a larger initial stake tend to take significantly more risks, simply because it doesn't feel like their hard-earned money they're risking. It also explains weird behaviors like why someone might drive 20 minutes across town to save $30 on a $750 TV, but wouldn't dream of driving 20 minutes to save the same $30 on a $50 lamp. Objectively, $30 saved is $30 saved. But saving $30 on the expensive TV feels like a bigger win because it's a larger percentage of that specific mental account TV purchase. Saving $30 on the cheap lamp feels less significant relative to its mental account.
Or that classic concert ticket example.
Right. Kahneman and Tversky's famous scenario. Imagine you bought a $100 ticket for a concert. On your way there, you realize you lost the ticket. Would you buy another $100 ticket? Most people say no. Now, scenario 2. Imagine you plan to buy the $100 ticket at the door. On your way there, you realize you lost $100 in cash. Would you still buy the ticket? Most people say yes. Objectively, the financial outcome is identical in both scenarios. You're out $200 if you want to see the concert, $100 initial cost plus $100 replacement loss cash. But mentally, they feel different. Losing the ticket and buying another feels like doubling the cost within the concert account, $200 for one show. Losing cash feels like it came from a general cash account, separate from the concert account, making the $100 ticket purchase feel more acceptable.
So how do we fight this? How do we get our brains to accept that all dollars are green and should be treated equally?
It really requires constant self-awareness and discipline. You have to consciously, repeatedly remind yourself, a dollar is a dollar, regardless of how I got it or what mental label I've put on it. Be vigilant about how you mentally categorize money. Try to resist treating windfall money differently, that bonus. Treat it with the same strategic thought as your regular salary. Integrate it into your overall financial plan, that gift money from Aunt Mildred. Don't mentally earmark it for something frivolous unless that aligns with your overall goals. Consider it part of your total financial picture. The best defense is probably to have a unified budget and financial plan where all income sources feed into the same pot and all spending-saving decisions are made based on overall priorities, not arbitrary mental buckets.
A unified view. Makes sense. Okay, let's shift to another cognitive bias, this one about how the presentation of information affects us. Bias 6, framing.
Framing is incredibly powerful and often very subtle. It's all about how a choice or a situation is presented. The words used, the context given, can dramatically change our preferences and decisions, even if the underlying facts and options are logically identical. It's not about the substance, it's about the packaging. How something is framed plays on our mental shortcuts and our emotional responses.
Like those optical illusions. You mentioned the multiplier illusion earlier, the lines that look different lengths because of the arrows on the ends, even though they're the same. Is it like that?
That's a perfect analogy. Same line, different frame, the arrows, different perception. In finance, this shows up all the time. For example, investors are consistently swayed by whether potential outcomes are framed in terms of gains or losses. People are generally more willing to take a risk to avoid a stated loss than they are to take the same risk to achieve an equivalent gain. Loss language triggers fear. Gain language triggers less powerful emotions. It can even mess up things like risk tolerance questionnaires. How the questions are worded, emphasizing potential gains versus warning about potential losses, can lead investors to choose portfolios that don't actually match their true comfort level with risk, simply because the framing nudged them one way or the other.
And you mentioned that study with doctors.
Yes, a classic study demonstrated this powerfully. Doctors were presented with a hypothetical scenario about treating 600 patients infected with a deadly disease. Group 1 was told, if you choose treatment A, 200 people will be saved. Positive frame, lives saved. Group 2 was told, if you choose treatment A, 400 people will die. Negative frame, lives lost. Logically, the outcome is identical, but guess what? Doctors in Group 1 were far more likely to choose treatment A, the certain outcome, than those in Group 2 who were more inclined to choose a riskier alternative treatment framed differently. The framing save versus die dramatically shifted their choices, even for highly trained professionals making life and death decisions.
That's genuinely chilling. If doctors can be swayed like that, what hope do the rest of us have? How do we combat framing effects?
It really underscores the need for critical awareness. For advisors, we need to be incredibly mindful of how we phrase questions, how we present options. It absolutely matters. We have a responsibility to try and present information as neutrally as possible. For you, as a listener, as an investor, the key is to actively cultivate the habit of reframing choices for yourself. When presented with an option, consciously try to restate it in the opposite frame. If it's framed as a gain, think about the potential loss. If it's framed as a loss, think about the potential gain. Force yourself to focus on the core facts, the underlying numbers, the objective probabilities. Strip away the emotional packaging and look at the unvarnished reality. Consider both the upside and the downside in neutral terms before deciding.
Reframe it yourself. That's practical advice. Okay, next, cognitive bias. Another one about how our brain processes information, specifically what's easy to recall. Bias 7, availability bias.
Right, the availability heuristic or bias. This is another mental shortcut. Our brain estimates the likelihood or frequency of an event based on how easily examples or instances of it spring to mind. Events that are more vivid, more recent, more emotionally charged, more frequently reported in the news, or simply more familiar to us personally are perceived as being more probable or more significant than they might actually be, according to objective data. It's if I can think of it easily, it must be a common or important trap.
So, we hear constantly about plane crashes because they're dramatic news, so we think flying is riskier than driving, even though statistically driving is far more dangerous.
Exactly that. Plane crashes are highly available to our memory due to media coverage and drama. Car accidents are statistically common, but less memorable, less available. So our perception of risk gets skewed. In investing, this availability bias manifests in several ways, often leading to pretty poor choices. One is retrievability. Investors choose investments based on what's easily recalled. Maybe something heavily advertised, something a friend mentioned, a company that's always in the news rather than doing disciplined research. They buy what pops into their head first. Another is categorization. They might ignore entire asset classes or countries simply because they aren't familiar or aren't currently hot topics. If it's not in their easily available mental category, it gets overlooked, even if it offers great potential. Then there's narrow range of experience. People limit their choices to what they know from their own life, investing only in their own industry or only in companies in their local town because that's what's familiar and available to their experience, even if better global opportunities exist. And finally, resonance. Sometimes people pick investments that just feel right or resonate with their personality, maybe a company whose mission they like, while ignoring others that don't have that same available emotional connection, even if the financials are better.
And studies show this affects individual investors more.
Yes, research indicates individual investors are more prone to buying these attention-grabbing stocks, the ones with lots of news, high recent trading volume, the ones that are easily available mentally. But these stocks, on average, tend to underperform the broader market. Professional investors, who typically have more resources for systematic research and screening, tend to be less susceptible to just buying what's currently making noise.
So, ironically, being bombarded with financial news, making information more available, might actually lead to worse decisions if we just react to the most available stuff.
It absolutely can if you're not disciplined. That's why beating this bias requires active effort. You need to engage in thorough due diligence. Don't just react to headlines. Actively diversify your information sources, not just your investments. Consciously make an effort to broaden your investment horizons beyond what's immediately familiar or heavily publicized. Dig into less glamorous sectors, research companies that aren't household names. Don't just pick what's easy to remember or what everyone's talking about. Ask yourself, what opportunities might exist precisely because they aren't easily available or widely discussed right now?
Look beyond the noise. Great advice. All right, let's tackle a big emotional one, something that could be really damaging and maybe a bit hard to admit to. Bias 8, overconfidence.
Ah, yes. Overconfidence. This is a powerful, often ego-driven, emotional bias. It's essentially an unwarranted faith in your own abilities, your own judgments, your own predictions. It leads you to systematically overestimate how likely you are to succeed and significantly underestimate the risks involved. It usually shows up in two main ways. Prediction overconfidence, where your forecasts about the future, like market returns or company earnings, are way too precise, too narrow, failing to acknowledge the huge range of possible outcomes. And certainty overconfidence, where you have an excessive, unjustified belief in the accuracy of your own knowledge or judgments. Basically, you think you know more and are better at this than you really are.
And this toxic brew of thinking you're smarter than you are and underestimating risks, how does that cause people to actually lose money in investing?
It drives some of the most consistently destructive behaviors. Chief among them is excessive trading. Those studies by Odine and Barber, like the one titled "Boys Will Be Boys," are classics here. They found that investors who traded the most frequently earned significantly lower returns than those who traded infrequently. Why? Mostly due to higher transaction costs, commissions, bid-ask spreads, and consistently poor timing, buying high and selling low more often. Their data showed average annual turnover for individual investors was around 80%, and the most active, 20%. They earned substantially less than the least active investors, often having their returns wiped out by costs. Overconfidence fueled value-destroying activity.
Wow, 80% turnover. That's turning your portfolio almost completely every year.
Incredible, isn't it? Overconfident investors also routinely underestimate downside risk. They just don't fully consider how likely it is that they could lose a lot of money. They might believe their stock-picking skill is so great they don't need to diversify much. Or they think they're smart enough to foresee and sidestep market crashes. Spoiler, they're usually not. And there's hindsight bias mixed in too. After a winning investment, an overconfident person might subtly rewrite history in their mind, making it seem like the positive outcome was totally predictable based on their brilliant analysis, rather than acknowledging luck or market trends. This reinforces their false sense of superior predictive powers, which then encourages even bigger, riskier bets next time. And conversely, they might heap undue praise on a fund manager after a good year, attributing it all to skill, not luck, or a bull market, leading them to chase that hot hand right before it cools off.
So the cautionary tales, like Jesse Livermore you mentioned, who made a fortune in the 1929 crash, but then got so overconfident he made bigger and bigger bets and lost everything.
A perfect, tragic example.
And that Warren Buffett quote, "Success is a lousy teacher. It seduces smart people into thinking they can't lose." Both seem spot on for this bias.
Absolutely spot on. There are timeless warnings against letting success go to your head. To combat overconfidence, the antidote is humility and objective feedback. Regularly review your actual trading records, your real performance history, cold, hard numbers, not just the stories you tell yourself. Get an unbiased view of your wins and your losses, and importantly, why they happened. Understand that most investment outcomes, good or bad, result from a complex mix of factors: market movements, economic shifts, luck, timing, and your decisions. It's rarely just your individual brilliance, especially on the upside. Remember, don't confuse brains with a bull market. Acknowledge the role of luck. Be humble. And always build in room for error in your plans and your portfolio. Assume you will be wrong sometimes, maybe often, and structure things so that being wrong doesn't wipe you out.
Humility and room for error. Crucial. Okay, let's hit our ninth and final bias for this deep dive, another cognitive one that often partners up with overconfidence. Bias 9, recency bias.
Recency bias. This is our tendency to give far too much weight to our most recent experiences or the latest data when we're making decisions or forecasting the future. We tend to extrapolate recent patterns, assuming they continue indefinitely, often based on historical samples that are way too short to be statistically reliable. It's like our brain's short-term memory, its RAM, completely overshadows its long-term memory, the hard drive. We focus on what just happened and forget the decades of history that came before.
So basically thinking that whatever's been happening lately, good or bad, is the new normal and will just keep going forever, that sounds like a recipe for buying high and selling low.
It absolutely is a recipe for exactly that. Recency bias leads to some of the most common and damaging investment mistakes. Investors prone to it will forecast future returns based almost entirely on the last year or two. If returns were great, they expect great returns to continue, often leading them to pile into assets right at their price peaks just before things reverse. Buy high. They ignore fundamental value, what a company is actually worth based on its earnings or assets, and focus solely on recent upward price momentum. This dramatically increases the risk of losing principal when investments inevitably mean revert, when prices snap back towards their long-term averages. This bias is what fuels that incredibly dangerous phrase you hear at market tops. It's different this time.
Ah, yes, the 4 most expensive words in investing.
Exactly. People use recency bias to convince themselves that historical patterns of valuation, bubbles, and cycles no longer apply. They ignore centuries of evidence because the last couple of years felt different. It also causes investors to abandon sensible asset allocation. They get infatuated with whatever asset class is currently hot, maybe tech stocks in the late 90s, real estate in the mid-2000s, maybe something else today, and they concentrate their portfolio there, ditching diversification just when it's most needed. They chase the recent winner.
The dot-com bubble, again, seems like a perfect example, right? The recent memory of stocks only going up, seemingly forever, convinced people to ignore all historical valuation rules. They genuinely believed the old economics didn't matter anymore because the recent past looked so different.
It's a textbook case. One of the most vivid and costly examples of recency bias leading millions astray. To beat it, you have to consciously force yourself to look beyond just the recent past. Actively consult a much broader historical context. Dig into data going back decades, not just months or years. Tools like those periodic tables of investment returns can be really helpful here. They visually show how different asset classes perform each year, and the rankings jump around constantly. It vividly demonstrates how unpredictable short-term leadership is, hammering home the value of diversification. You'll notice diversified portfolios usually hang out near the middle of the return rankings. They rarely hit the absolute top in any single year, but they also rarely hit the absolute bottom. They provide more consistent, less volatile returns over time. So the key is stick to a sensible, diversified asset allocation based on your long-term goals. Rebalance periodically to maintain that allocation, which forces you to sell recent winners, combating recency, and buy recent losers. Patience and that broad historical perspective are your absolute best defenses against chasing the latest trend off a cliff.
Fantastic. That covers the 9 biases brilliantly. It's incredibly clear just how much these mental shortcuts can cost us if we're not aware. Simply understanding them feels like a massive leap towards financial wisdom. But okay, beyond just knowing the biases, the potential pitfalls, what are some of the bigger, maybe more timeless lessons that can really empower us on our financial journey, taking us beyond just avoiding mistakes towards actually building lasting wealth and maybe just as importantly, peace of mind? Let's start with some of the really fundamental you touched on, the almost magical power of compounding and time.
Yes, this is absolutely foundational. It's one of the most powerful forces in finance, yet it's often deeply counterintuitive for our linear thinking human brains. The core idea is that long-term consistency and patience are infinitely more potent for wealth building than trying to achieve spectacular but likely fleeting short-term gains. And the story of Ronald Read, the janitor from Vermont we mentioned earlier, is just the perfect illustration. It's almost unbelievable, but true. When he passed away in 2014 at 92, people were stunned to learn he left over $8 million, mostly to his local hospital and library. This was a humble guy, lived incredibly frugally, drove used car, patched up his own coat. He certainly didn't look wealthy.
So no lottery win. No secret inheritance.
None at all. His secret was astonishingly simple, yet incredibly hard to execute for most people. He consistently saved what little he could from his modest earnings throughout his very long life. He lived well below his means, and he consistently invested those savings, mostly in solid, blue-chip, dividend-paying stocks. And then he just waited. For decades, he let those tiny, consistent savings grow and grow, with dividends reinvested, compounding year after year, decade after decade, for probably 60-plus years. Tiny acorns grew into a mighty oak of over $8 million. His skill wasn't complex financial engineering, it was discipline and patience. But his real secret weapon was time. the extraordinary runway he gave compounding to work its magic.
It's hard to grasp intuitively, that exponential growth.
It really is. Our brains think linearly. 8 plus 8 plus 8 equals 24. Simple addition. But wealth compounds exponentially. 8 by 8 by 8 equals 5, 12, 12, a completely different scale. We dramatically underestimate what small, consistent actions can achieve over very long periods because the big results feel so far off, so abstract. Think about Warren Buffett. His net worth is staggering, right? But something like 99% of it came after his 50th birthday, and a huge chunk after his 65th. He built an amazing base, younger, sure, but the truly explosive growth is overwhelmingly due to the sheer length of time he allowed his investments to compound well into his later years. He wasn't necessarily the investor with the highest annual return every single year, but he combined good returns with an unparalleled time horizon. Time is the magic multiplier.
That's incredibly inspiring. A janitor becoming a multimillionaire through sheer patience and time. And it connects perfectly to the next timeless lesson you highlighted. Wealth is what you don't see.
Yes, and this is perhaps the hardest financial skill for many people to truly master in our consumer-driven, comparison-obsessed culture. Getting the goalpost to stop moving. It means consciously resisting that relentless pressure of social comparison, keeping up with the Joneses, and that seemingly endless, insatiable desire for just more. More stuff, bigger house, faster car. Because true wealth, sustainable wealth, isn't defined by the flashy things people spend money on. Those things, the fancy car, the designer labels, the huge house, often signify not wealth, but massive debt, high expenses, and a constant need to maintain an appearance. Instead, true wealth is, as the saying goes, income not spent. It's the savings quietly accumulating, the assets growing in your retirement accounts, the investments silently appreciating in value. These are the assets that provide real options, true flexibility, genuine security, and future growth. And importantly, they don't need to be put on public display to be valuable.
Which is why it's hard to learn from truly wealthy people sometimes.
Exactly. This hidden nature of real wealth makes it inherently difficult to emulate or even recognize. Ronald Read wasn't anyone's financial role model while he was alive, precisely because his wealth was unseen. It was managed diligently, lived below its means, quietly compounding away. He didn't live a life designed to impress others. And perhaps the ultimate unseen return that this hidden wealth provides is control over your own time. The freedom to wake up and say, I can do whatever I want today. The ability to choose work you love regardless of pay, to spend time with people you care about, to pursue interest, to handle emergencies without financial panic. That autonomy is truly priceless. You can't easily measure it like an interest rate or a portfolio return, and what we can't easily quantify, our society tends to overlook or undervalue. But arguably, that control over your time is the highest dividend money can possibly pay, the gift of freedom.
The highest dividend is control over time. I love that. So if that's the goal, this profound freedom that true wealth offers, what's the cost? You mentioned earlier nothing worthwhile is free. What's the inevitable price of investing to gain that wealth?
Absolutely. Nothing worthwhile is free. And the market definitely demands a price for the potential of long-term returns. But the currency it demands isn't dollars and cents, not directly anyway. The currency is psychological. It's paid in units of volatility, fear, doubt, uncertainty, and yes, regret. These are all incredibly easy to underestimate when things are calm, but they feel intensely real when you're living through them, when markets are plunging, headlines are screaming crisis, and your gut is telling you to run for the hills. Many investors mistakenly try to avoid paying this price. They try to time the market, jumping in and out. They try to sell before the next downturn and buy back in before the next rally. They think they can get the returns without the discomfort.
But they usually end up paying more.
Often, yes. By trying to dodge the inevitable fee of volatility and uncertainty, they frequently end up paying double. They underperform a simple, disciplined buy-and-hold strategy because their timing is off, they miss the best recovery days, and they rack up transaction costs. That Morningstar research finding that the average investor underperforms the very funds they invest in just due to their own bad timing behavior is stark evidence of this. The real trick, the mindset shift, is to fundamentally convince yourself that the market's fee, the volatility, the fear, the uncertainty is worth paying for the potential long-term reward. Think of it like an amusement park analogy again. If you view the admission fee as an unfair fine or a punishment, you'll never relax and enjoy the amazing rides inside. You have to accept that volatility isn't a flaw in the system. It's a feature. It's the price of admission. And then you have to be willing to pay it emotionally by staying the course.
Accept volatility as the fee, not a bug. I like that. Okay, and what about planning for the curveballs life throws, the things we just can't see coming? That brings us to that critical concept you mentioned,
room for error.
Room for error. This is so important, and it's often misunderstood. Building room for error into your financial life isn't about being overly timid or conservative. It's actually one of the most strategic things you can do. It simply means you have to actively plan on your carefully crafted plan, not going exactly according to plan. Because life is, fundamentally, a continuous chain of surprises. Unexpected things will happen, good surprises, bad surprises. Having that buffer, maybe extra cash reserves, maybe not being leveraged to the hilt, maybe having diversified income streams, maybe just not needing your investments to perform perfectly every single year allows for endurance. It lets you survive the inevitable setbacks, stick around long enough for the good luck, the positive tail events, those low probability but high impact good outcomes to eventually fall in your favor. Endurance is key.
So it prevents you from getting wiped out by a single bad event.
Exactly. There's this dangerous optimism bias in risk-taking that leads people to take chances where failure means total ruin. The Russian roulette should statistically work out most of the time kind of thinking. You should never take a risk that has the potential to eliminate you from the game entirely, no matter how attractive the potential upside seems. Survival comes first. Remember that quirky historical anecdote about German tanks in World War II? Some were apparently defeated not by enemy shells, but by tiny field mice chewing through the insulation on their electrical wiring inside the tank.
No way. Field mice.
Believe it or not, it's a great metaphor. You can meticulously plan for all the big, obvious risks. The enemy tanks, the artillery, but sometimes it's the crazy, unpredictable, seemingly small things, the financial equivalent of those field mice that can do the most damage because you didn't even conceive of them as a possibility. This is why saving money just for the sake of saving for things you cannot possibly predict or even comprehend today, is one of the absolute best reasons to save. Your savings aren't just for the down payment on a house or the planned retirement date. They are a crucial hedge against life's inevitable, stunning ability to surprise you at the worst possible moment. They provide resilience against the unknown.
Savings as a defense against the unknowable future. That's powerful and often overlooked. Okay, shifting gears slightly. We tend to think we know ourselves pretty well, but people change over time, don't they? Let's talk about adapting to your evolving self in something called the end of history illusion.
This is a really profound insight from psychology, and it has huge implications for long-term financial planning. The reality is, people are actually remarkably poor at forecasting who their future self will be, what they'll want, what will make them happy. It's easy and often fun to sit here today and imagine a future financial goal, maybe early retirement on a beach, maybe a huge house, maybe achieving some specific net worth number, we visualize it, but actually living that reality years or decades down the line amidst all the real-life stresses, changing relationships, health issues, evolving interests, unforeseen global events, it can feel entirely different from the simple vision we had. Think about that example of the ambitious young person who grinds relentlessly through medical school, achieves the noble goal of becoming a doctor, only to find themselves utterly miserable years later due to the immense stress, the crushing hours, the toll on their personal life. Their younger self couldn't accurately predict how their older self would feel.
We don't realize how much will change.
Exactly. We don't fully grasp how much we will adapt to new circumstances, both good and bad, and how our fundamental desires, values, and priorities will naturally shift as we age and experience life. This means that extreme financial plans often fail in the long run. Plans that demand perpetual, extreme austerity, denying all present enjoyment for a distant future, they often become unbearable. Plans that demand endless workaholism to fund ever-increasing luxury. They often lead to burnout or regret over missed life experiences. Why? Because they don't account for our evolving nature. The end of history illusion is this psychological quirk where we tend to believe that the person we are today is the finished product, that we won't change much more in the future, even though we can clearly see how much we've changed from our past self. Recognizing this illusion is key. It means building flexibility into your long-term financial plan is absolutely crucial. You need room to grow, room to change your mind, room for your priorities to shift, room to pivot as life unfolds. Rigidity is the enemy of long-term financial happiness.
Flexibility for the future you, who you haven't even met yet. That's deep.
No.
Okay, one last major theme. The way our brains crave stories and the importance of embracing uncertainty, especially in finance. Let's talk about the narrative trap.
Humans are storytelling creatures. We have this deep, fundamental, almost biological need to create coherent narratives, to connect the dots, to make sense of the world around us, even and maybe, especially, when the information we have is incomplete, random, or contradictory. Our brain automatically tries to fill in the gaps, to weave events into a cause and effect story. This process, sometimes called confabulation, creates what feels like an illusion that the world makes sense. It makes us feel like we understand why things happened, and therefore we feel we can predict what will happen next. But this narrative instinct, while helpful for navigating daily life, often leads to significant mistakes in fields like finance, because we don't realize how much we don't know. We impose a neat story onto what is often messy, complex, and significantly influenced by randomness. We mistake correlation for causation. We see patterns in noise.
It feels better to have a story, even if it's wrong.
It feels much better. Certainty feels good. Uncertainty feels uncomfortable. Contrast with a field like, say, astrophysics. It deals with fundamental physical laws, incredible precision. We can predict planetary orbits centuries from now with mind-boggling accuracy. Now compare that to finance. Finance is overwhelmingly a field dominated by profound uncertainty. It's driven not by immutable physical laws, but by the messy, shifting, often irrational behavior of millions of humans reacting to news, emotions, and each other. As a result, we are, quite frankly, very, very bad at making accurate market forecasts, especially in the short to medium term. Anyone who claims they can consistently predict market movements is either fooling themselves or trying to fool you. Trying to predict the stock market with the precision we expect in physics is just. It's applying the wrong framework to the problem. It doesn't work that way. So the crucial takeaway here is this. Coming to terms with how much you truly don't know and how much is genuinely unknowable about the future means coming to terms with how much of what happens in the financial world and in your own financial life is simply out of your direct control. And that can be really hard for our control-seeking brains to accept. But accepting that uncertainty, embracing it even, is absolutely vital for making sound, long-term financial decisions and, maybe more importantly, for maintaining your emotional equilibrium through the inevitable market gyrations.
Wow. Okay. So after diving deep into all these biases, all these human quirks, and these timeless lessons, it seems clear the goal isn't to magically transform ourselves into perfectly rational, emotionless Homo economicus robots who optimize every penny. That sounds impossible and maybe not even desirable. So what is the goal then?
The goal, really, for anyone striving for financial well-being isn't robotic perfection. It's simply to be psychologically reasonable. The fascinating thing is these fundamental patterns of human nature and finance, the very things that create the biases and pitfalls we've discussed, they also point towards real, practical, and profoundly accessible solutions. By understanding these inherent biases, by acknowledging their power within ourselves, and by consciously, deliberately applying these timeless financial principles we've touched on, you absolutely can navigate your financial world with much greater certainty, much more resilience, and ultimately, genuine peace of mind. These core actionable takeaways, they cut across everything we've discussed. They're simple on the surface, but incredibly powerful in practice. First, give your money time. Truly embrace the slow, patient, astonishing magic of compounding. Don't underestimate what small, consistent actions can do over decades. Second, be okay with a lot of things going wrong. Understand that success, especially in investing, often comes from a few big winners, tail events, while many other bets or plans might just break even or fail. That's normal. Diversification and room for error are your allies here. Third, save for things you can't possibly predict. Build that buffer, that room for error, that defense against the field mice of life. Because life will surprise you. Savings provide resilience against the unknowable. And finally, fourth, define the cost of success and be ready psychologically to pay it. This means accepting market volatility not as a fine or a mistake, but as that necessary admission fee required to access potential long-term rewards. Embrace it, or at least tolerate it, rather than trying fruitlessly to avoid it.
Time, resilience, saving for surprises, and paying the price.
Exactly. These foundational principles, rooted deeply in understanding our own human nature and combined with sound financial wisdom, are your most powerful tools. They empower you to make smarter, more resilient financial choices. Choices that truly align with your long-term goals and ultimately lead to lasting financial peace, which is what it's really all about.
What an absolutely fantastic deep dive. Today, we've really journeyed through the ultimate guide to the psychology of money, haven't we? We've explored how our own minds, our inherent biases, can quietly sabotage our finances, costing us real money. But more importantly, we've uncovered how understanding and consciously countering these biases can truly empower us to build lasting wealth and, just as vital, achieve a sense of control and peace. We've seen so clearly that finance isn't just math, it is profoundly, fundamentally human.
And please remember, these insights we've shared, they aren't just abstract theories from a book. They are practical, accessible solutions and frameworks you can apply to the real-life financial challenges and decisions you face every single day. By integrating these ideas into how you think about money, by starting to observe your own mental traps and reactions, you absolutely can approach your financial future with greater confidence, less anxiety, less regret, and much more peace of mind.
So now we turn it over to you, our amazing listeners. What really stood out to you from today's deep dive? Did you recognize one of these biases may be playing out in your own financial life? Perhaps one of the timeless lessons like compounding or wealth being unseen or room for error really resonated with where you are right now. How might you use this understanding, starting today, to navigate your own financial world a little differently, to start beating these biases? We genuinely would love to hear your thoughts, your experiences, your takeaways. Share your insights down in the comments section. Let's continue the conversation. If you found value in our deep dive today, please consider subscribing to the channel, maybe give us a like, and perhaps share this with a friend or family member who you think needs to hear this vital message about the psychology of their money. Your engagement, your participation, it truly helps the deep dive community grow and allows us to keep bringing this kind of essential knowledge and conversation to you. Thank you so much for joining us for another deep dive. We really appreciate you spending your time with us, and we look forward to having you back for the next one.